Hi, I'm Jimmy Atkinson, founder of the Opportunity Zones database at OpportunityDb.com and host of the Opportunity Zones podcast. Welcome to today's webinar, Class A Multifamily Developments in Fast-Growing Opportunity Zone Markets. Today's webinar is sponsored by Origin Investments, and I'm very pleased to be joined by principal and co-founder of Origin Investments, Michael Episcope. And I'll bring in Michael in just a moment. Origin Investments, it's fantastic. They made the news, you may recall, a little over a year ago. They raised over $100 million or received over $100 million in capital commitments for their Opportunity Zone fund in under 24 hours of announcing it. Maybe we'll touch upon that later today. But some of the other things that Michael and I are going to be discussing today include the strategy that Origin Investments is using to deliver a 3x after-tax net multiple on equity over 10 years. We'll also go through the details on some of their Opportunity Zone funds multifamily projects. And Michael has a very specific example that he'll do a deep dive into for you. And he'll also discuss what makes them unique. We'll also discuss the fund's rapidly growing pipeline and also the criteria that Origin Investments has used to select the fast-growing target markets that they're currently focused on. And finally, toward the end, we'll discuss how you can participate in the fund. Before we do officially get started, just a few things to keep in mind. As always, yes, this webinar is being recorded. So everyone who registered for this webinar today will receive access to the video recording. I'll get that out to you probably by tomorrow afternoon. So keep an eye out on your inbox for that email. If you'd like access to the recording, if you missed anything, you'd just like to rewatch it, that'll be coming to you tomorrow. Secondly, we are going to have time for a Q&A session at the end of today's webinar. So if you do have a question that you'd like to ask Michael or myself, please do use the Q&A tool in your toolbar. We also have a chat function on the Zoom call today, so you can use that as well. But if you have a specific question that you would like me to address to Michael in our Q&A session, the last 15 or 20 minutes, it'd be helpful if you use the Q&A tool. That makes it a little bit easier for me to manage the questions. Also, throughout the course of the webinar, we're going to ask you some questions, some multiple choice polls. There'll be really simple questions just to kind of gauge the audience and see what you think about some topics that Michael and I are curious about your thoughts on. So we'll get to those in a few minutes. But now, without further ado, it's my pleasure to introduce today's featured speaker, Michael Episcope. He is the principal and co-founder of Origin Investments. Michael, please take it away.
Thank you, Jimmy. Appreciate you having me on today, and welcome everybody. It's funny, as you were introducing me, I heard you say Class A multifamily developments in QOZ, and I have to imagine for a lot of people out there, they view that as sort of an oxymoron. And one of the goals today that I want to make sure I convey is the notion that those two things do operate together. And there's a big misconception about QOZ zones, and we hear it all the time about how these are distressed areas that you don't want to invest in. And I would agree with that, 85 or 90% of the time. But I think you'll see, based on the case study that I'm going to provide today, that that's not true, that there's always exceptions to the rule. And I thought what we do today is talk about our firm, the fund, and then go a little bit deeper into our latest acquisition, which is Elan, Pikes, to give everyone a flavor of what we're looking for in our typical deal. So let me start by talking a little bit about Origin for a few minutes. We were founded in 2007 by my partner.
Hey, Michael, let me interrupt you there. We were having a little bit of trouble with the screen share. It looks like it's kind of caught between slides. If you could just maybe toggle back and forth real quick. There you go.
Okay.
That looks good.
What are you seeing now?
I'm seeing about Origin Investments now.
Okay.
That looks good.
Okay. Got it. So we were founded in 2007 by my partner, David Shear, and me. And really at the core of what we are, we're a real estate investment firm, and we provide institutional quality real estate investments to family offices, RIAs, and high net worth individuals that allow them to continue to build wealth and generate passive income in their portfolios. And we always talk about one of our core values, which is alignment. And when I said that we started the firm back in 2007, it was because we were investing a considerable amount of our own personal capital in private real estate. And I think it's a very unique position when you are both the investment manager and also the largest investors at the firm. And so this notion of alignment we've always taken this with us between us and the investor, our team and us, our team and the investor, and made sure that we're building a firm with the institutional qualities, but geared towards the individual taxed investor. And that's a very unique characteristic of Origin, because a lot of firms like ours, they start with the individual investor and then they move on to the pension funds and endowment area. And we've made a conscious decision to continue to serve this area of the population, this demographic. Now, we typically operate through fund structures, and we've had a lot of success in the last 13 years. We've had the honor of twice being named a top decile fund manager, and most recently being named one of the consistent top performing fund managers by an organization called Prequin. And they're a third-party fund manager. They have more than 10,000 funds on their database, and they look at those and they slice and dice everything. So we're honored to be part of that. In terms of the particulars, we are headquartered in Chicago. We have 4 offices throughout the country. We are in Denver, we are in Nashville, we are in Chicago, we are in Charlotte, and we had an office in Texas, and we'll probably be opening that up again very soon. And we're primarily in the multifamily space. We've done a lot of office in the last 13 years. We've also done a lot of industrial as well. But today, 90% of what we do is in the multifamily space. We do everything from acquiring core plus opportunities for income plus fund to value add on that side as well. So these are existing projects that might need a little bit of TLC, some capital improvements to generate more income, and then all the way to ground up development. And QOZ is obviously a ground up development fund. So we have quite a bit of experience across the spectrum. And today we own and operate close to about 4,000 units. We have another 1,000 units under construction as well. And we've executed around $2 billion, kind of plus or minus right around there in deals. And I'm happy to say we serve more than 1,200 investment partners. And that's really exponentially grown as we've applied technology into our system, allowed people to come in and invest with us much easier. So 5 years ago, we had about 75 investors. And as we've applied technology and we've done events like this through OpportunityDB and gotten our name out there, we've had quite a lot of success with the individual investor market and the RIA segment as well. Let me jump to the next slide. So this is our team. This is really what we call the heartbeat of Origin. We have 33 dedicated team members across a multitude of departments. And I could literally talk about any one of them for 10 minutes. They're all just great, but they help make Origin what it is today. And the core of the team is what I'll focus on. It's really separated into 3 disciplines: acquisitions, finding good deals; investment management, managing those deals, making sure that the business plans are executed; and then investor relations and marketing. So keeping our investors in the know, quarterly reporting, using technology to make it simple and easy to invest in our funds, conduct due diligence, and then a lot of education around there as well. So those are sort of the 3 core disciplines, because our goal, it's not only to produce great returns, and that's the role of acquisition and investment management, but it's also to ensure that the entire investment experience, from due diligence to document signing to ongoing quarterly reports, is the most positive that it can be, because that's sort of what I'll call the third leg of the stool that we have really focused on, and want that user experience to be just incredible when people invest with Origin. Now, the point I want to make about this slide is that this is what we call business as usual. And this is a term my partner actually coined many years ago, and it fit perfectly, because when we first considered launching a QOZ fund, what we found is that when we talked to our team and said, look, we want you to start looking at these areas, we want to understand this better. Can we execute in this area? Is there enough deal flow as well? And what we found overwhelmingly was that we had already bought deals in QOZ areas, and that we were looking at a lot of deals in QOZ areas as well. And so we were in them before QOZ was even an acronym. And I think that's a really important, unique point about our organization. So we've always invested on the fringes in the path of growth. And that's been our model since when we started 13 years ago. And the second important thing about this is that our base is high net worth, the taxed investors. So when you look at a government program that's focused on the taxed investor, our model and our strategy fit right into it. And I do want to, the reason why I'm pointing this out is because it was interesting when we first launched our fund, we might have been one of 10, one of 12. And I think there's hundreds out there, institutional investors now coming down to the high net worth world, other people concepting funds and things like that. And I just want people to understand this is something we've been doing. We've been playing in the same sandbox for 10 to 12 years, and we're set up perfectly to execute. And it was a very easy choice for us to go out and start a fund in this area. So let me,
Michael, hey, let me interrupt you there before you move on. We're going to get to the rest of your presentation in a moment, but I wanted to launch our first poll question first. Michael and I were curious how you would characterize your capital gain, the Opportunity Zone tax incentive being a capital gain incentive. So a lot of you in the room have capital gains, but we want to know, are those capital gains realized already and maybe the clock is ticking against you, you're approaching a deadline, or maybe you have unrealized capital gains that you can harvest at any time, whether it's a stock portfolio or maybe a business you're thinking about selling. So if you could take a moment just to answer this poll question. This one's an anonymous poll question, so feel free to answer. It just takes a minute here, and I'll just give everybody a few more seconds to chime in with some answers here. If you have unrealized capital gains, you can harvest at any time, or if you have realized gains and your deadline is fast approaching, or maybe if you have a mix, or if you don't have any capital gains. So a few more seconds here to get in some more responses here, and then we'll end the poll and share the results. And it looks like actually quite a few people on the call today don't have any capital gains at this time, but they're just coming in to learn more about opportunity zones. Maybe they will have some gains at a later date. We do have a handful of people who have kind of a mix of both unrealized and realized, and so people in different boats here. Michael, what do you think? What do you think about that? Those poll results?
Yeah, I'm a little surprised, but it doesn't. I mean, for me personally, I don't really have control over my capital gains because they come a lot in the on the partnership side, and I think that's the majority of our investors as well. But certainly, for people who do have control and they can sell stocks or get out, that's a luxury. That's a really nice luxury because I know a lot of our investors are now getting their tax documents at year end, and they're searching for opportunities and ways to take advantage of QOZ.
Absolutely, yeah, yeah. A lot of different types of investors out there with gains of all sorts. And yeah, you're absolutely right. You have control over when you can realize the gains. That makes things a lot easier. I know that at least in my network, there are a handful of investors that participate in the stock market sell-off in February and March, and their clock is ticking. They have just until the end of the year to place their funds. So anyways, I'll let you continue on with your presentation here, Michael. Go ahead.
Sure. Yeah, the slide you see in front of you is actually a map of all the properties that we have in the fund currently. So, as Jimmy said, we do focus on Class A properties in QOZ areas. And the portfolio right now exists of a property in Phoenix. It's actually very well diversified. Phoenix, Houston, Chicago, Orlando, Charlotte, and Colorado Springs. And Colorado Springs, we are closing right now. We're actually in the midst of transacting on that deal. And then Orlando is going to be the newest deal that we put into the fund. And that hasn't actually been announced. This is a first on your show, Jimmy, here. So if there's existing investors on the call today as part of Origin, I'm sure this is the first time you're hearing about it because we just, we approved the deal a couple of weeks ago, but we just got notice today and we're able to strike a deal with our partner in there, and another exciting deal about it. Now, we do focus primarily on multifamily in this fund, although we do have latitude to do both office and industrial. You will not find any office in this fund. We've already talked about some of those deals, and in a post-COVID world, that is not the asset class of choice, but certainly we are considering some industrial, and we've actually bid on a few ground up multifamily developments. But let me focus on the multifamily side and what we do, because that's going to be primarily the bulk of this fund. And, for those who are looking at investing in real estate in a post-COVID world, what we like about multifamily, and especially in the Class A space, is number one, this is an essential asset class. You can't sleep on the internet. It's not going to take the market over like retail. The other thing is that we focus on a renter by choice. And this is really what the Class A goes to. And I don't, Class A can be defined in many different ways. But most importantly, the renter by choice is somebody who has a higher income. They are your white collar workers. They are less susceptible to layoffs during a downturn. And even when you look at COVID right now and you bifurcate the market and look at who was laid off and which properties are suffering as a result, if you are in workforce housing right now, your properties are probably 80 to 85% occupied and your collection rates are suffering as well. But in the Class A space, it's very different. These are generally people who have more than one means of income. They have savings, they have family, they have credit scores that they really treasure as well. So they don't want to miss their payments or get reported and stuff. And so any recession, when you look at this, is really going after the blue chip of the market. And this is what we focused on historically, and what we're focusing on in this fund as well. Now, the fund itself, we've raised and invested more than $100 million across these 6 assets, and all of them are in some phase of development, whether that's in the planning phase or going vertical. And the fund itself, if investors buy in right now to the fund, you're buying in at all of these assets at their cost basis. At the end of this year, we are actually going to start floating the unit price. And what that means that we will start marking the assets to market. And that was just the decision we made early on, because with a construction project, it tends to take about 24 to 36 months to build, lease, and stabilize. And our fund our unit price was fixed at $10 for the first 2 years. And we just correlated that with basically the time that it would take to create value. So anybody who's coming in at this point will be buying in at the basis of all the projects. We will be investing in this fund through next year, meaning that we're taking investments from investors this year and through the end of next year, and then the fund will be closed. So as we sit here today, the fund has around 6 investments. It could be 8 next year, it could be 10, but it will be a diversified fund across geography and in a lot of the markets that you're seeing in there, because we primarily focus on growth markets and assets just in great locations. And we always get the question too, are we investing? And the answer to that is yes. So my partner and I have committed, and we've already invested a minimum of $7 million. We use our own products as our primary means of investing our capital. We love the deals we put in the fund. We have high conviction in them. We're putting our money into the fund as well. And we always talk about it. If we had more capital gains, we would put more into the fund. So I can tell you, I've been hounding my tax attorney to find me more capital gains, because I am excited about what's in the fund, but also just the program itself.
Michael, maybe you can go into why you believe in your investment thesis as much as you do. Why multifamily in fast-growing OZ markets? And if you want to get to it later in the presentation, if you have that planned already, you can defer to later. But that's a question I have for you right now.
Yeah, let me, I think it's best with a case study, and that's what we have planned here. And I think that, a good deal speaks for itself. I'll talk about Elan Pikes Peak, which is the most recent deal that we added to the fund.
And Michael, again, the screen share got a little bit glitched up, so maybe you can just go toggle back. There it is. That looks good now. Yep, that's
got Elan Pikes Peak?
Yep,
okay.
Got it.
Not sure what's going on. I see it on my end. But this is a deal that's really indicative of all the deals we look for. And every deal has a story and an edge to it and a reason why we buy it, and has a tailwind to it as well. So this just happens to be the newest deal. I could really talk about any of our deals in the fund, and we can go through some of those later. But Elan Pikes Peak is in Colorado Springs, Colorado, and that's just an hour south of Denver. But this is a multifamily property. It's a Class A development. It's 322 units. It's 6 stories, and we're capitalizing this with 65% debt and 35% equity. And you can see the pictures in front of you. Just an absolutely gorgeous building. But if you've read anything that we've put out, or just anything out there, you'll know that we really favor lifestyle communities, especially in a post-COVID world, as you get this virtualization of the office. And if I'm 25 years old right now, which I'm a little bit older than that, and I'm looking for a place to live, this would be it. I mean, Colorado Springs, Denver, other lifestyle cities, Austin, if I don't have to go into work every day and more companies are going virtual, I want to be able to look at the mountains. I want to have world-class skiing within 2 hours. I want to have hiking trails, biking trails, you know, right outside my door. I want to have 325 days of sunshine. And so we were really excited when we found this deal, and we're adding it to the fund. But those are some of the elements that this community offers to any renter here. And we see that kind of happening, a small demographic shift as a result of what's happened in COVID. Now, we believe as a firm that this is going to continue, and lifestyle cities will, they've gotten a little bit more of a shot in the arm. People were already moving here before, but now even faster. So this is a city that has a lot of untapped potential. Let me go into, I'll talk a little bit about the deal, and maybe high level too. One of the things that's happening here that's really idiosyncratic to Colorado Springs is Denver has seen robust growth. And if you move there, if you live there, you've seen this. Well, with robust growth comes traffic and traffic jams and sitting in cars and all of the growing pains that you get with a big city that you may have loved 10 years ago, and now you're hating it. And so instead of it taking you an hour and a half to get up to the skiing in Summit County, on the weekends, it takes you 3 hours. And what that's doing is really pushing a lot of people towards Colorado Springs, because Colorado Springs, I would equate it to what Denver was 10 to 15 years ago. It has all the charm, a downtown that's starting to come to life, but it doesn't have the growing pains and the challenges that Denver is experiencing. And you've seen this. I mean, I love Denver as a city. It's great, but you're starting to see this 24/7 work-live environments because people just don't want to live in their cars and be driving. And you're starting to get that congestion as well. There's a lot of corporations who are starting to move here as well. Job growth always helps with multifamily because you can build it, but ultimately you need people who are going to rent it. And we've got Amazon a couple miles away building a 4 million square foot distribution warehouse. Now, the Amazon worker isn't necessarily our tenant demographic here, but there's plenty of people within that Amazon distribution center who can. The upper level management, just anybody who's not what I'll call the line worker, right? Who's making $20 to $25 an hour can afford to live at Elan Pikes Peak. You've also got Aerospace Corporation that's building a $100 million facility. They're bringing in 200 jobs. And there's just countless examples of corporations either expanding or moving headquarters down here, and just robust growth. The other thing we like about this is this project is located in the downtown area, and it's highly walkable to jobs, to nightlife. It's, as I said before, easy access to mountains. You have great connectivity. You're 4 blocks away from the highway. So if you want to, shoot back up to Denver, and they also have an airport here. And we visited a few weeks ago, and I just made the assumption that we had to fly into Denver from Chicago. And so the whole team went there, and we went in there, and we were driving by the airport, and I said, could we have flown in here? I was like, yeah, they have nonstop flights from Chicago all day. I'm like, okay, I had no idea, right? So they do have a commercial airport there where people can fly directly. It's certainly not as big as Denver if you're going to fly to international, but you're an hour away. But great connectivity throughout the Front Range and everything else. And the other thing about this, and I should mention that we have a phenomenal development partner, probably the best in the nation. We're developing this with Greystar. They're a partner. They have more than $15 billion of development experience across the nation, and certainly one of the most preeminent developers that we could possibly partner with. And they'll be in charge of the day-to-day construction of the project, overseeing it, the planning, the GMPs, and then our investment management team works hand in hand with them to make sure that they're building the project on time and on budget. And the local Greystar team, they're actually located in Denver, so they know the area very well, and that's where we have an office. And our team has been looking for a project in Colorado Springs for 2 years now. So this has been a long time coming. And Elan it's a highly amenitized building that is easily the nicest property in all of the downtown. Now, I'm sure some people think about, well, it's the nicest, but it's not the most expensive. And those two things, when you can couple value with price, that's when you really hit the intersection. And so the reason why too is we are able to conservatively underwrite this and hit rent projections on that inferior properties are reaching today. And I'll just say anecdotally, we were down there. When we were down there, we met with some developers, and they are achieving far greater than their pro forma rents. And Colorado Springs was one of the only markets in the entire country not to give any rent concessions or have a reduction in rent, during that entire COVID period. So it just speaks to a lot of the strength that's happening in the market. So when I look at the underwriting and deals get presented, we always look at what are we building it for? What are the assumptions on the exit? How realistic are those assumptions? And you have to kind of do the math and ask yourself if those are achievable. And oftentimes when you're building the nicest project in the market, you have to set new rents in the market and look at that. And generally you're going to be 10 to 15% over the closest rent, but you're building the nicest project in the market. And that's not the case here. We're actually achieving rents that other properties today are achieving. And we're not, our underwritten rents are 3 years out and we're not trending those. So very important about the conservative way that we're underwriting the project and how we evaluate risk in projects as well. So this so the only thing I want to talk about here with this particular slide, and I failed to mention this, but we have one of the reasons why our return on cost is so high and our margins on this development is that we have a tax abatement from the city. So in a project like this, historically, you might pay $500,000 per year in property taxes. But the city is providing incentives for organizations like ours to come and build and start revitalizing the downtown area, because we are, probably one of the first, 3 or 4 projects in this downtown area. And a lot of cities do this, and they provide tax incentives, and then those go away in 1 or 2 years. And we did the same thing in many cities. And anytime you can be the first to market and get the tax incentives, it's a huge advantage over future developers. So here we're getting a tax abatement, and just for easy numbers, if we're going to pay $500,000 in property taxes on this building, they're going to be reduced substantially by almost 80%, so that our tax bill will only be $100,000. So what that means is that you have more cash to flow to debt service, so it reduces the risk of the property substantially from the debt service coverage ratio. And then you also have a higher yield here as well. So any cash flow that we get as a result of the tax abatement will flow through to investors. How are we doing, Jimmy, on time?
We're doing pretty well, Michael. I'd say keep it moving here. I'll interrupt you in another minute here with poll question number 2, but wanted you to get through some of these investment projections first. So please continue.
Well, this is everybody's favorite part. So we'll look at investment projections. Hopefully I painted a good picture of why we like Colorado Springs, why we like this deal. But here's where the rubber meets the road. We literally look at hundreds of developments throughout the year, all across the nation. We cover 11 different cities. And there are very few that we see where all the stars line up. And this particular deal, it has incredibly high margins, and we measure that by looking at a metric called return on cost. So those of you who are in real estate, you'll know this term, and the return on cost here is 6.6%. And that's about a 35 to 40% development margin on this particular property, which is really, really healthy. And ultimately, it's the high development margins that translate into high risk-adjusted returns to our investors. And the way that you can think about a return on cost is, I'm pretty sure that everybody is familiar with what a cap rate is on the call. So if the prevailing market cap rates are 5%, which they're lower than that today, and you're developing to a 6.6 return on cost, you're essentially developing it to a cap rate of 6.6%, but the market is 5. So you can take that 6.6% in income and sell it to somebody once it stabilizes at 5, and that becomes your margin. Hopefully that's clear. Now, one thing that is helping our margin is the financial support from the city, and that tax abatement is worth about $6 to $7 million. And the net is that we're looking to generate about a 2.5x multiple on this particular deal. But really, that's our standard underwriting. So when you're looking at the fund multiple, and this is a net multiple, this is after all fees are considered, but the fund multiple is exactly the same. So we have a minimum multiple projection on every deal that we look at of 2.5x over that 10 years. And that's on a pre-tax basis, pre-benefit basis. We don't look at QOZ investing any different than we do non-QOZ. There isn't a special model for QOZ. The tax benefit here flows exclusively to the investor. So I'll get to the after-tax equivalent in a second, but what you're looking at, it doesn't factor any taxes in, and this meets our cost of capital. But we're excited to add this deal to the fund because we just rarely find deals that have all the qualities that we're looking for. Certainly the other deals in the fund, when you're looking at, if you've got 6 boxes to check, you might get 4 out of 6, you might get 5 out of 6. And I feel this one is probably as close as you get to 6 out of 6. So the other thing here that you'll see on this chart is that we do stress tests. And so you stress test in a couple ways. Number one, we're looking at our base case scenario. 10 years out is a long time to project, but you have to make some assumptions around your model. What are your growth assumptions on your revenue? What are your growth assumptions on your expenses? What is your cap rate going to be? And so what we do then is we do sensitivities around that. What happens if we start rents $100 lower? What happens if we start them $100 higher? What happens if cap rates go up by 10%? And what happens if they go down by 10%? Because there's always, for every downside scenario, there's an upside scenario. And I will say that out of all the deals we've done, we've never lost money, and we've had more upside scenarios than downside scenarios. So when we look at a base case here, we look at it as what is the likelihood of achieving that base case or better, right? And that's what makes us feel good. And oftentimes, if we're underwriting to a 2x, when you're looking at something over 10 years, one thing we know is wrong are the projections. So it could be that this is a 2x, it could be this is a 4x. What we know is it's not going to take that nice, line that you see in front of you. Real estate and all investments, they might end up where you project them to be, but they take kind of a squiggly line along the way and up and down. So you can see as we stress test this, and increase cap rates and decrease revenue, you get a variation, but it's still a positive return here. And so this is what we're trying to do. And one of the reasons for that is because the amount of equity that we're putting into this deal, we're capitalizing it with 35% equity and 65% debt. So you have a very conservatively capitalized project. And by the way, that is a loan to cost ratio I just talked to you about. And if we do our job on a loan to value, right, because we're building a project and we want it to be worth more when we're done, on a loan to value, that's going to be around a 50-50 ratio. So incredibly conservative model, but that's how we look at it. Are we good?
This is where it gets exciting for me,
okay.
Michael, because this is the after-tax stuff now.
Yes.
So taking into account the opportunity zone incentive, right?
Yes, you are. Well, people do this in different ways, and I'll take you through the math and how I put this together and how we put this together. So you can look at, let me just go through this really quickly. So this is what we call the tax equivalent multiple. And the way this is defined is, what would you have to earn if you were to have capital gains this year? And you decided, hey, I don't want to invest in a QOZ fund. I don't want to invest in a QOZ deal. I'm going to pay my taxes. And then I'm going to have that money to put to work. So that's your first column. And for ease of numbers, $250,000, you're going to pay about $60,000 in taxes. And what that leaves you with is $190,000 to invest. And what this is showing, that if you invest that $190,000 and you decide that the government needs the money and you want to pay your taxes, you need to generate a 3.66 multiple on your equity to create the same amount of wealth as you would had you just invested in a qualified opportunity zone that generates a 2.5x multiple. And you can see the numbers here, and you can go to check these. it's accurate. And so what happens is the reason why the net equity multiple is so high is because your year 10 investment value, what we do is the bottom lines, you can see the year 10 after-tax investment value of 576, because keep in mind that any money you make on a QOZ investment, when you sell it, you do not owe taxes so long as you hold it for 10 years and a day. So if you take this after-tax money in the left-hand column and you invest it and you do unbelievably well, and then you sell it, well, you still owe taxes on that gain as well. So to get to 576,000 in wealth, that's what you have to make. On the right-hand side is that same $250,000 that you generated in taxable gains, and you don't owe any gains this year because you're going to defer those into the future. And so you have $250,000 that you are investing, and $250,000, you need to generate a 2.5 multiple on that. That will end up at $630,000 in total wealth, of which you then have to pay your deferred tax liability. And we're assuming here the tax rates don't go up. We can talk about that, et cetera. But ultimately, you get to that same 576. So QOZ is unbelievably compelling, and it's one of the reasons why we love this program so much. And it is helping communities revitalize. Some of the money is being put to really good work out here. But if you like real estate and you're even considering QOZ or ground up development, you have to look at QOZ here because the after-tax benefits are just so much greater than anything else out there. And you know, the other thing that a lot of people are looking at the election and you know, making different assumptions, who's going to win, we don't know. It's very likely though, over the next 10 years, doesn't matter who's going to win this election, that taxes are going up. We've got huge government deficits right now, state, municipal, local, everywhere. So if you believe they're going up, then QOZ, when you do the math, it even becomes more compelling to do this because the savings you make on an investment that grow tax-free far outweigh the risks you might be taking with the capital gains that you're deferring to 2026. We can talk about that a little bit more. Last thing here, I'll talk about this, but the fund will be providing $17 million of the required equity here. We actually, this deal required $32.5 million of required equity, but we syndicated another $15 million last week. And we actually had quite a bit of interest in that. We actually had $25 million of demand that came through in a week on this particular project. And we had to, you know, shave people back on their initial commitments, but our fund investors were able to invest in a sidecar along the fund. And that was just downsizing the opportunity because we typically look for $15 to $20 million slugs in the fund. But if you want opportunity, or if you want allocation to this opportunity, it has to be done through the fund and everything else.
Yep, that's perfect, Michael. I'm going to interrupt you there before you continue. I think you've got a few more slides left, but I wanted to launch our second poll question. I want to know, and Michael wants to know too, what is the source or sources of your capital gain? And you can select more than one here if you want. So the first choice is publicly traded securities, whether that's in the stock market, maybe ETFs, mutual funds, bonds, et cetera, anything that's a publicly tradable security. Real estate, maybe you sold some real estate or you're thinking about selling some real estate. Privately held business that you may sell. And then a couple less frequent options, but plenty of investors I've seen, handful of them anyway, have some gains from either collectibles or Bitcoin or other crypto assets. So we'll give you a few minutes to, or a few more seconds to answer that poll question. And yeah, just one more comment on what you were saying earlier, Michael, about the capital gain rate risk, right? For 2026. You know, you're absolutely right. If the gains go up, it kind of eats into your deferred gains, right? Because then you're actually ending up paying potentially more taxes on your initial capital gain. But it really, in the long run, it makes this incentive way more powerful because you are excluding capital gains on the back end at a much higher rate too. So, you know, I get that question pretty frequently from people who are concerned about, hey, wait a second, what if capital gains rates go up? I'm gonna be paying a higher rate in 2026. It's like, right. You got to keep your eye on the prize long term. And, you know, long term, it's like, well, it really makes the incentive even more powerful. So I'm going to wrap up this poll question now. and we will share the results here with everybody. And it looks like the majority of you have gains, about 2/3 of you have gains from real estate, about half of you have gains from publicly traded securities, and about 1/4 of you from privately held businesses. Nobody selected collectibles or Bitcoin today. I have had people select those options before, so I like to keep them in there, but I know that it is it's pretty rare, and with this audience it's non-existent. But there you go, Michael. That's where everybody's capital gains are coming from. And I'll let you continue. I think you've got a few more slides to go through, and then just as a reminder, we are going to leave some time at the end, probably about the last 10 or 15 minutes, for Q&A. We've had a few questions come in already. I'm holding them to ask Michael at the end. If you do have a question, please use the Q&A toolbar. And just a warning, we're usually not able to get to all of the questions. So the sooner you can get your question in, the more likely it is that it'll be answered. So don't be shy. Ask your questions. Use that Q&A tool in your Zoom toolbar. Michael, go ahead.
Yeah, those findings are consistent with what we've seen too. And we certainly see people who are kind of shying away from the stock market just because of the volatility and the high valuations, and the private businesses too, especially on the larger commitments. We've seen a lot of individuals who have punched out of a business or had some liquidity event, and we see them also allocating money towards the QOZ fund. So this is we always get this question about cash flow during the hold period. And there's a couple ways that cash flow is returned to investors. If you think about the life cycle of a development project, 24 months to build, another 12 months to lease and stabilize. So you're really about month 30 or 40, 35 to 40 when you're refinancing the project. And so if you look at the bottom line, that's where we plan on returning about 20 to 30% of invested capital to investors through refinance. And that's a non-taxable event, so you don't have to worry about that. And then what you also have to consider is a lot of people look at this as, oh, it's ground up development, it's risky, and that is true. We believe that we've mitigated a lot of the risk, and that's why you pay us as well, so that we manage that risk throughout. But the other part is that, this investment is what we call build to core. And you're building a Class A project in growth markets, and then you're holding it for 7, 10, 15 years potentially. So the majority of your hold period is actually in a very conservative asset, but you have to decide if you want to, if you're okay taking that initial development risk, because in a QOZ fund, you have to double the cost of the investment basis, which really lends itself to only ground up development in these funds. So let me jump here. This is just a basic primer on QOZ law, and I'm sure a lot of people on the webinar today understand this, but I'll go through this very, very quickly. But if you invest in 2020, this year, you have capital gains, you will get what's called two things. Number one, a step up in basis, but you'll also get a deferral until 2026, and those taxes will be paid in 2027. So if you have a $200,000 gain this year, and you invest that $200,000 into QOZ, you will not owe those taxes until 2026. And on top of that, your $200,000 will be reduced by 10%. So you will only owe $180,000 in capital gains in 2026. So a very unique part. Last year was 15%. This year it's 10%. Next year it will be 10%, but then it goes to 0. So part of that increase in tax is mitigated by the fact that you have this step up in basis. And then lastly, if you hold the asset, the investment for 10 years and a day, anything you make on the investment, whether it's in real estate or another QOZ business asset, if you put in $1 million and it grows to $3 million, you owe nothing on that gain when you get out. If it grows to $10, $100 million, and there's a lot of QOZ here where people are trying to put businesses as well into QOZ. So a lot of favorable reasons to get in to QOZ, whether it's through real estate or businesses. And then lastly, the terms of the investment. So as I said before, my partner and I have already committed and invested $7 million. We'll be investing more into the fund this year. The target return is right around a 2.5 net multiple over 10 years. There is a 1.25% annual asset management fee for managing the assets and paying our team. On top of that, there's a 0.5% acquisition fee that we charge to each deal. So there is no committed fee to the fund. We actually take investments on a rolling basis. In a closed-end fund, what you normally have is a committed fee, but because this is operating more as an open-ended fund, we've changed that committed fee now to an acquisition fee. Then there's a performance fee. The investor gets the first 7% of the investment, and then we have a 15% performance fee subject to a catch-up. And lastly, there's an admin fee. So for new investors, that'll be anywhere between 0 to 2%, and that's on a scale depending on how much you invest in the fund. And lastly, this is how you can invest. We do a lot through the technology. You can go through origininvestments.com. You can visit there. You can register on the platform. It takes 5 minutes to do. Once you're in the platform, you will see an offerings page, and you can review our offering materials. You can go to the QOZ fund page. You'll see all the documents. You'll see webinars on our website as well, FAQs, and you will be assigned with a personal Origin representative. And after you've read the documents and have an interest or have questions, then you can reach out to that person. They're all very knowledgeable from the real estate industry as well. They can help you answer the questions, and then with next steps, and take you all the way through the investment process. So thank you.
Perfect. Thank you, Michael. So yeah, please do visit origininvestments.com and sign up to review the offering materials that they have there on their website. I actually took the time to register at origininvestments.com. I registered at a lot of different Opportunity Zone sites as I was putting my site together and putting together everything that I'm doing all the research I'm doing at OpportunityDB. And Origin Investments is great at the registration process. It's really simple, just takes about a minute. And then they do have a wealth of material available on their website for you to review. We got some good questions here that we're going to pose to Michael in just a minute, so keep them coming in. But first, I did want to launch our final poll question. Here it is. Do you plan on investing in the Origin Investments Opportunity Zone Fund within the next 6 months? You can answer yes, no, or maybe you're still doing research. You'd like to learn a little bit more. And if you do want to learn more, of course, please do head to origininvestments.com. And we'll keep this poll question up and running here, give everyone a chance to answer it. But first, let's move on to the Q&A portion here now. So Michael, question here is, what's the timing for investors, and when does their clock start ticking if they invest in your fund, and when does the fund close? Can you talk a little bit about how the timing works there?
Yeah, so for an investor, the date by which they're sort of time stamped is when they're accepted into the fund. So every investor has a unique situation in terms of their own QOZ gains, when that clock starts ticking, when it expires. But we have an open fund right now, meaning that we're taking investments on a rolling basis. So if you committed to the fund today, we could have you in the fund tomorrow. Very simple process. We use DocuSign for everything. We have a great team who handles all this. And in terms of your other question about when does the fund kind of close or stop taking investments, that will be at the end of next year. And then we're going to decide next year if we actually want to start another QOZ fund. But there are a couple of nuances around compliance with QOZ law. An investor can actually get out in 10 years and 1 day from the time they invest in the fund, right? That's on a best efforts basis by us, so long as we have cash flow. We as a fund manager, though, cannot sell an asset. If we do sell an asset prior to 10 years and a day from the last investor getting in, then we will violate QOZ laws. So for us, we can't sell any assets until 2032, but investors can actually get out in 2031 if they want to. And the way we've designed this fund is that it will be a mark to market based on an appraisal basis. And if you want to get out in 10 years and a day, we will put aside the cash to be able to let you out. But there's some people who they don't know. Myself personally, I want to stay in this as long as I can. I don't want to take something that's growing tax-free and then turn that into a taxable investment. So I most likely will be here until the end of the program, investing for another generation. So we created some liquidity into the fund itself, but also optionality. So if you want to stay in for 20 years, you can. If you want to get out in 10 years, you can.
Good. And a follow-up question from me: what's the fund's exit strategy? You know, when the 10 years comes up and 10 years after the closure of the fund, what is the fund's exit strategy exactly? How do you spin off those assets?
The fund is, we plan on holding the assets so long as the investors want to hold the assets. Now, if enough investors redeem, we actually have this in the PPM, we are forced as managers to sell the assets. But in my experience, the way you get wealthy in real estate or any asset is you buy and hold forever. You don't take a great asset and flip it in 3 years and make a great IRR, pay taxes, and then try to do it again and take more risk and more risk. If you look at the way family offices and any wealth manager, they'll tell you that time in the market is so much more important than timing the market or chasing IRR out there. So this is, again, what we call build to core. And this is the way, once we've built a margin of safety and we've returned everybody's capital, I have a feeling that there are going to be a lot of people who just want to stay in for the ride and let that continue to grow tax-free. But the people who I know, and especially some of the wealthiest people in the world, they've got that way from, buying and holding good real estate for long periods of time.
Yeah. So, this could be a very long-term hold, 20 plus years, generational hold potentially, but there is optionality to exit if you need to, or if your investors would like to. That makes sense. But yeah, you might as well, if the investment's doing well, might as well let it continue to eat, as we like to say, let it keep getting that tax-free growth, right? So
yeah, and as I said, we got some really good feedback early on from our investors, and they weren't comfortable with just pure optionality. So then we worked with them and we said, look, if, and I think the threshold is 20%. If 20% want to get out of the fund, then we will be forced as managers to sell an asset to create that. Otherwise, you can use cash flow. If 2 or 3% want to get out, but 97% want to stay in, then we really shouldn't be selling an asset if that's the vote. So you let people vote with their checkbook along the way, with the idea that, we understand that different people have different needs in this.
Right. Yeah, that makes perfect sense. Let's keep moving on with the questions here. A question from Joe here. Is the end of the year, he puts in quotes, the only time on a QOZ that makes sense?
I'm not sure I understand exactly, but
I think maybe he posed this question when I mentioned a year-end deadline for a lot of investors. So
okay.
I can address that one. So Joe, and forgive me if I'm not answering your question, but some coronavirus relief measures that were published by the IRS has kind of pushed back the original 180-day investment window for investors just to the end of this year. If I'm remembering correctly, I believe anyone who has any capital gain recognition event since October 4th of 2019, their 180-day window no longer applies. It's just simply the end of this year. So I think that's what we were discussing at that point in time. So Joe, I hope I answered your question there. And if I didn't, you can kind of chime in again. But let's move on to another question here from Karen. She asks if you have any environmental considerations and specifically climate change considerations as criteria when considering new project sites, for instance, limiting coastal projects.
We don't invest on the coast on purpose. We're just not in the primary markets. We've always taken an approach. Our approach has been to secondary markets, kind of a little bit underneath the radar. That might have been true 10 years ago. It's not today. So we don't invest in Miami. We don't invest in LA. We don't invest in New York. Was it a conscious decision around climate change? No, but I think if you look at the makeup of our portfolios, they're mostly inland, except Houston, but that's very far inland because that's in East Houston.
Right. I don't believe your fund has any sort of mandate to work around climate change or any climate change mitigation, but you're simply trying to generate a good market rate return for your investors first and foremost. Correct me if I'm wrong.
We're not an ESG fund by that nature, but if you look at our 11 markets, none of them are on the coast, and I would think that they will benefit from maybe not benefit, but they're not as susceptible to climate change as maybe some of the ones, the larger cities that are on the coast.
Yeah, fair enough. Yeah. Lauren has a question. He asks, as an investor, do I earn interest on my investment during the rolling enrollment period?
Interest is a term I wouldn't use. You earn what's called a preferred return. So people have what's called a capital account that starts on the day that you invest. And the way a preferred return works, an interest rate implies that this is a loan and it's guaranteed. Preferred return is your capital account. So assuming everything goes well in this investment, it goes through what's called a waterfall, and your preferred return gets paid off first, right? That's the very first thing that happens. So in this case, a preferred return protects the investor's downside. So if we only made 7% on this investment from an IRR perspective, we as the manager would not get paid anything, and you would get your preferred return plus everything, plus your investment back. If we earn above that, then we are entitled to a performance fee. But I wanted to also, that might have been the question before about the advantage of investing now versus the end of the year. And it could have also been about the mark to market. So investors start earning a preferred return from the day they invest their capital, and that accrues in their capital account. But then on top of that, at the end of the year, in the first quarter, we're going to be marking the assets to market, the ones that are under construction and we've owned for several months, almost 2 years, some of them.
Right. And you're continuously deploying that capital to projects. You're not just letting all of the capital accumulate and then in 2022, you're going to make a big capital deployment.
No,
first of all, that would violate the terms of the program. I just wanted to make sure that maybe that wasn't his question, but.
No, absolutely. As a fund manager, I mean, it is, we've run, this is our 5th fund that we've operated, and it's one of the more challenging funds to operate just because QOZ has some nuances around the law from an investment manager perspective, how we have to stay in compliance, but then you're also trying to help the investor and make sure that they're staying in compliance. And so this fund has, we had to change a lot of the ways that we take in money and we invest money and the way we manage money in this fund versus some of our simpler closed-end funds that have been around for a while. And every manager has had to deal with this.
Sure. Understood. Jack asks, can you explain your thoughts about the importance of no depreciation recapture under the Opportunity Zone incentive, and how does that affect your fund?
So there isn't any recapture. Generally, you still get depreciation, and we're going to be keeping track of everybody's cost basis, but your cash flow is going to come largely tax-free. So the first event is a refinance, and refinancings are not a taxable event. So you can actually return quite a lot of money through that event. And then an annual cash flow after that. And we're predicting kind of somewhere in that 6 to 8%, 7 to 9%, somewhere around there. And that's all shielded by depreciation. So you don't have a recapture when you sell. Normally in real estate, for those of you who might be wondering what we're talking about, if you use depreciation on an annual basis, that actually goes against your tax basis, so that when you sell, you are subject to something called a recapture tax. I don't want to get into the accounting behind it, but it's a tax advantage of depreciation, but you are making up for some of it on the back end when you sell through the recapture. But on a QOZ investment, there is no recapture. It's completely a tax-free sale.
Right. I kind of consider that to be one of the hidden benefits, because we always talk about the deferral and the reduction and then the capital gain exclusion after 10 years. But it's an incentive that doesn't get talked about enough, I think, is that depreciation recapture elimination. So we're getting close to the top of the hour here, but we got a couple more questions I'm hoping we can get to here. If you got a little bit of time, Michael, stick with us here.
I got time.
Good. So Eric asks, how are you sharing the social benefits from your QOF investments, since they are in low income census tracts and the core driver for creating the Opportunity Zone initiative? And he goes as far as speculating that perhaps in the future we may have some reporting requirements. So if you were required to report on impact, Michael, what would you consider your impact for the resident where you're making your investments?
So our investments, that was the purpose of the QOZ law originally, is that this was a bipartisan agreement between Republicans and Democrats, and you always have to be concerned when they agree on something, right? Republicans wanted to help unleash these tax benefits for the wealthy, and the Democrats wanted obviously this money to flow into these poor neighborhoods. I'm going to just say, do I think that it was perfectly designed? No. And I'll say this is probably QOZ one of many iterations that it's going to be. Are we revitalizing and helping neighborhoods? Yes, in some ways. We're not in workforce housing though. So something like Elan that I talked about, we're one of the first groups coming in there to help revitalize those neighborhoods. But one thing that everybody needs to understand is that QOZ is not, QOZ dollars are not going to necessarily find their way into the neighborhoods that need them most, because this doesn't help a developer or an investment manager buy a property cheaper, or it doesn't supplement the capital structure. So this benefit is purely on the back end from the investor when they make money. I can sit here and try to create a tenuous argument for this, but the developments that we're doing are in downtown areas that are revitalizing. Some people might hear that as gentrifying. And these are developments that wouldn't happen otherwise. So there is job creation behind this. There is a revitalization of some of these downtown, but it also takes a joint effort between public and private. So a lot of the developments that we are doing have tax abatements to help with that incentive in these communities, but we're not necessarily going into low income areas, and not all QOZ areas. There was a lot of discretion by governors to draw lines. And so for our model, our first and foremost is to produce an investment return to our investors with these deals. So again, we're in the path of growth and we're looking at the same neighborhoods we were 10 years ago, but this has certainly helped accelerate the program and has created a lot of good jobs out there.
Right. That makes sense. Couple more questions, then we're going to wrap it up and let everyone get on with the rest of their day. We're just a couple minutes after the top of the hour here, but a question from Steve that just came in. Are you acting as a land holding company and partnering with the developer? Or what is the exact relationship or structure there?
So we are, we're the investment manager. So we bring the capital to the table. Generally what we do is we bring a developer into, and we partner with them. So this is on every project. We don't do development in-house within our organization. We don't guarantee loans. The fund doesn't guarantee loans. So we look for shovel-ready projects that with best-in-class developers, and we partner with them. And almost every development sponsor there, they have a model where they're in it to put development fees in, and they want to put 5% of their money and then go raise the other 95% of that money. And that's a very common throughout the industry. And so what we're doing is bringing the investment management expertise, and we sit on the side of the investor to make sure that the developer is doing their jobs. And by the way, we see hundreds of opportunities every year. I talked about this, and I would say 90% of them, they don't pass the sniff test for being a good investment, because there is a conflict of interest between a developer and an investor, especially in today's day and age. And developers have a development shop, and they need to keep developing to feed the beast, if you will, right? And it's our job to decide if the development will actually produce returns. And so that's where we come in, is really scrutinizing the quality of the project and the ability for it to generate returns in that matter. But almost everything we do is a joint venture with the developer, and it's our job to oversee the development, and we have majority control in everything we do, because it's the golden rule. We're bringing the majority of money, so we make the rules.
Makes sense. And then one final question from me to you, Michael. What are some of the most commonly asked questions that you field from investors or potential investors? Or is there one in particular, or maybe two in particular that you'd like to address before we sign off?
We get a lot of questions. So, I think it depends on the deal. If we're talking about the fund, people ask me what keeps me up at night. I think what we're really good at though is risk management, and that's my partner and I at our core. That's our backgrounds. That's our business. This is what we do. Risk is, if you want to, make money, you have to take an element of risk, but it's also something that I believe you can mitigate a lot on the front end. And that's by picking the right projects, being in the right markets, investing with the right people along the way. So what keeps me up at night? I'm always thinking about risk and how to mitigate it, and how, we can deliver on our promises and what we say we're going to do. So those are the things, and just making sure that everything I talked today about in the materials about not only producing great returns, but a great experience. Those are things that from an operational perspective are just nonstop. So we have, one of our core values at Origin is just continuous improvement, right? As a person, as an individual in a department, what can you do to just get better? And that extends across our entire organization. So I think what keeps you up at night is a common question, or how does excuse me, bit my tongue. How does the deal go wrong?
Yeah, well, it's a great question to ask, and a good answer you have there. Risk mitigation is what it's all about.
Yeah.
Well, Michael, we're a few minutes past the top of the hour, so I'm going to let everybody get on out of here. Thank you, everyone, for participating and attending today. Very special thank you to Origin Investments, our sponsor today. Excellent presentation from you, Michael. Thanks a lot. Really exciting to learn more about your fund and the deals inside it, and thank you for the case study that you gave us as well. To learn more about Origin Investments and to start receiving their email updates and to gain access to their offering documents, please do visit origininvestments.com. Spend a couple minutes getting registered on their website. You'll be glad you did. And again, we will follow up tomorrow with an email telling everyone who registered where you can go to access the recording of today's webinar. Again, thank you, Michael, and thanks everyone for attending. Appreciate it.
Thanks, Jimmy. Thanks, everybody.